on the way up.
People have been borrowing yen and using that proceeds to invest in assets around the world. So that has been winding.
Markets staying in the green. The Bank Nifty, though, has just slipped into the red.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Well, we are all smiling, but the market is not smiling. The market is not hurting, but we're off the high point of the day quite a bit, actually. Banks is essentially the problem child here. We'll talk about all of that. This is Closing Bell, last hour coming up. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant Surbi, Reema with me here in the studios, and Nigel is joining in from the newsroom floor. Guys, hi, good afternoon.
Hi, afternoon. Is disappointing the word for today's trading session?
That's exactly the word that I had
when
in mind.
He said not smiling, not happy, I was thinking of it's a bit disappointing.
No, because, a lot of the Asian markets managed to retain some of that pullback. Some of the European markets are still flashing at least a little bit of green, but we have decided to go with red. Let's see. Last hour is still there, so let's see.
No, I think, so I think basically it's all global, right? Nikkei managed a 10% bump. The graphics will come up. You had Nikkei, which was up 10%, so almost reversing yesterday's losses. But the follow-through into Europe is not really visible to that degree. I mean, actually, very, very hesitant kind of moves across the European board. As I was coming in, I looked at the US futures. NASDAQ futures have cut their gains in half. I mean, they were up about 1.4%, I think about 0.75% higher. So I think, and of course, you look at the dollar JPY as well, that has also pulled back a little bit. The dollar was stronger, the yen was weaker, but the yen has moved up, the dollar has come off a little bit. So I think, at the margin, everyone is, of course, watching what's happening at on the global screen, really. Now, in terms of the levels, basically, the Nifty is about 300 points off the day's high. Bank Nifty, for a brief moment, broke yesterday's low. And I think it is starting to pull back a little bit once again. So, the low is absolutely same. So today's low is 49,660. Yesterday's was 49,719. So we broke yesterday's low for a brief bit, but we're trying to pull back here. And it also, the lows, by the way, coincide with a 50% retracement of the rally from the lows of the 4th of June. It's a level we put out in the morning as well, which is 49,718. We are now slightly above that level. So we'll watch this. Mid-caps and small caps are off the highs of the day. Market breadth has turned negative. It was comfortably in the green with more advances, but not anymore. So it tapered off, basically, and no real follow-through coming through. But I think it's to be expected. I mean, I think no one's case that we're going to see a V-shaped recovery. It's going to be a tricky trading conditions. But the fact is that the panicky kind of markets we had yesterday, that is not something we are seeing, at least. And I think that's the silver lining here. Reema.
Well, let's go through then some of the big movers in the frontline pack. So on the way down, life insurance companies are under stress. So HDFC Life, top loser, down more than 3%. SBI Life down 2%. These two are the top two large cap losers. Then you've got Bharti Airtel, muted set of Q1 numbers, no beat. The conference call will be beginning soon, 2:30 p.m. So we're going to keep our eyes firmly on that. In terms of the large cap private sector banks, which are dragging the Nifty Bank lower, it's HDFC Bank with a 1.25% gone, and ICICI Bank too is under pressure, down close to about 0.6%. On the way up, there is recovery in metals and IT. Though the recovery has faded, the Nifty IT index was up close to about 1.5% at early in the morning, and now it's only up close to about 0.5%. But names like Tech Mahindra, LTI, Mindtree are still holding on to about a 2% gain. Britannia is the top Nifty loser, and then you've got a few metal names like JSW Steel, which are looking up. That stock is just above its 100-day moving average.
At the move on IT, I think it's got nothing to do with the sort of a global rally or anything of that sort. I think it's probably more defensive in nature, more of a move to safety. These are great, cash-rich companies with proven track record, and not perhaps they haven't seen a very sustained rally. So maybe that explains the move back to quality, back to safety, which is why we're seeing that play out on the FMCG names as well. Just a word on the mid-cap market, and disappointing is, a word you can use even here, because the mid-cap index was cruising along in the morning, looked quite okay till about 10:30, 11. And then things started sort of falling through. The index is at the flat line right now, having lost all of its day's gain, and the advance decline ratio has also now turned in favor of declining stocks. They're basically outnumbering the advances, with some, some names from the PSU basket really coming up on top. So Bank of India, Realty, Aircon, UCO Bank. These are the names where there's price action on the way down, along with heightened volumes, and then some profit taking on names like Zomato, for instance, which is down about 2.5%. But yeah, I guess, Nigel, interesting next 55 odd minutes coming up.
Well, that's right. The disappointing part for me today is the breadth of the market. When we started off trade, there were only 150 stocks that were declining, and now you have close to 1,350 stocks. So those crisscross lines, they're telling you the picture, and that's why your portfolio may not be feeling too good. The Nifty Bank is the weak spot, and in fact, the breadth of the market as well has turned unfavorable from a bullish perspective. But as we said earlier today as well, it's the Nifty Financial Services Index weekly expiry, so maybe in fact a bit of a move is pending even on that front. Mitesh Thakkar is back with us. Hi Mitesh, good afternoon and good to see you, Ben. Well, it's become a sell and rise market. How are you viewing it? Are you short on the index, and if yes, what are the targets you're looking at?
Good afternoon, Nigel. I think that's exactly the way I'm looking at it. Sell and rise kind of a scenario. I think this is a market, which is now clearly showing signs that we would possibly see further declines, because what happened today was a gap up opening, followed by a failure of the index to sustain at higher levels. Both the Nifty and the Bank Nifty have tapered off. And while we haven't broken below yesterday's low, the structure is weakened. So I think, unless until 24,500 on the Nifty is captured, 24,500, 550, good chance that we will head lower. And the worst case scenario which I have penciled in is a retest of 23,900, which was yesterday's low, and then even 23,600, 500 zone, which would be a good, strong support area. So I think those levels could be tested. So maintain that idea of, sell and rise, or trade via put options in stocks or indices. I think that could be a good idea. Finance some of your put options by selling out of the money call options. That also could be a good idea. So that's the way we'll take it forward. On the stock side, I have a sell on Ambuja Cement with a stop at 641. Look for targets of 600 here. Maybe more, but I think that's the minimum which I'm penciling in. And the other stock which I have is on the list is ICICI Bank, which I would recommend selling with a stop at 1182 for targets of 1130.
Okay, all right, Mitesh, thanks a lot for that. Well, let's welcome Gurmeet Chadda as well on the show. Hi, Gurmeet, good afternoon and good to see you, Ben. Well, there are a lot of stocks that we want to discuss with you. So let's go through a couple of results that came in the last 90 minutes or so. Let's start off with Shree Cement first. The numbers actually are looking quite weak. On the top line, well, there was a volume growth of close to around 8%, which is a little bit better than what we were working with. We were expecting volumes of around 9.5 million tons. It came in at around 9.6 million tons. So that's a little bit better. The problem is on realizations, and that's the reason why these numbers are a miss. So despite having mildly higher volumes, the absolute top line number is a little lower than what we were working with, predominantly because of realizations. The EBITDA the absolute EBITDA as well is much lower. Came in at around 920 crores. We were working with the number in excess of around 1,100 crores. And that's what led the margins down to around 19%. That compares with around 23.5% that we're working with. What was the problem first? The realizations are weak. They are down by close to around 6%. And the other expenditure, well, that's up by close to 14%. So we'll require some clarity as to why the other expenditure surged up by such an extent. On the power and fuel cost, they have got some relief, because on a year-on-year basis, despite producing more, that cost is down by close to 7%. The problem for Shree Cement is the other two larger players, that's the Adani Group as well as Ultratech. They have been aggressive in acquiring companies as well as increasing their market share, while Shree Cement is doing everything organically. Valuations are not cheap, and that's the problem for Shree Cement. Gurmeet, what's your view on Shree as of now? Clearly some troubled times with the other two giants becoming aggressive. Their numbers are not really coming about, and margins are under pressure. Your take?
So as Nigel rightly said, it's the realizations, and if you see the expenses, there's some pickup in the employee expenses. Other expenses probably we need a more detailed breakup. How they are up 14%, and the margins dropped from almost 22-23%. Shree is known for better realizations and margin, and as you rightly said, valuations do not offer any miss. At these valuations, if you miss earnings or it's a slightly weak, we saw that with Ambuja also. Realizations were weak, so I think this is more an industry trend. But so got to be a little, I think we are headed into consolidation, but consolidation will probably take 3-4 years. Ambuja relatively, although everything is now 17-18 times, EV by EBITDA, Ambuja clearly has a goal of 140 million tons. The cost, they have maintained that the operating cost, they want to bring it down to 530 per ton, which means that in the medium term, they are in a way giving you a margin guidance. With consolidation, I think that could be something which can be looked at. Also down the order, if you look at some players in down south, there could be more acquisition candidates, all deals, whether it was Sanghi, almost at $95 a ton. India Cement was also at about $100 a ton. And south, there is a strategic focus. So I think you probably have somebody like a Sagar Cement and few names, which are still at about, let's say, $50 a ton. So I think in the short term, probably you're better off looking at more tactically acquisition candidates, which are well run, available at Sagar at $230 now is almost $45 a ton. And you're knowing acquisitions are happening at 2x the price. In the short and the long run, get into either the big one, either Ultratech and Ambuja, depending upon your view. I would probably prefer in terms of relative valuations, Ambuja in large cap and Saga Cement in the small mid cap space.
Okay, all right. Well, let's focus on the next set of number. Then we got your point on cement. You like Sagar Cement among other names. Let's talk about Vedanta then, Gurmeet. I wanted your view on the metal pack and how you all are playing that. The results, well, they were more or less in line with what the street was working with. Top line up by close to 6%. The EBITDA number was up by close to 55%. And margins, well, they expanded on a year-on-year basis on a very low base. They've got some benefit of lower power and fuel costs because despite the top line growing by 6%, the power and fuel cost was down by close to 5%. The PAT number as well did come in lower by 5%, but that's because in the base year, there was an exceptional gain. So that explains why we are seeing growth on the EBITDA front, but we're not seeing growth on the profitability front. Moving to their segmental performance, well, the aluminium business did very, very well. Just a few quarters ago, they were doing around 2,000 crores per quarter on the aluminium front. Well, that's gone up to more than 4,000 crores on a per quarter basis. So aluminium is the one that's driving the way. The problem is that aluminium prices have corrected post the first quarter. And that's why this profitability may not hold or will not hold actually. The oil and gas business, it continues to struggle. So you're still waiting by for profitability to catch up out there. Besides the numbers, the commentary is important. And, on the debt front, well, it's gone up marginally. The debt number on a year on a sequential basis actually has perked up a little bit, but that's par for the course. The management says that the demerger is on track. All the approvals are in. The key creditors like SBI and LIC, they have given their no objection certificate. So that's positive because the street is looking by for some value unlocking. And also they're saying they raise 8,500 crores by the QIP route. That's going to help them deleverage their books. They've also released the pledge on Hindustan Zinc's book out there. And they've said that the interest savings will be around 1,100 crores from this particular QIP. So put everything together, one of the best plays on the metal space. The numbers are good. The problem is the global environment has turned a little bit jittery, and that's why the stock is not reacting in that manner. Gurmeet, what's your take on this one?
So, I agree, Nigel, it's one of the cheapest metal stock available, but it is cheap for a reason. We know that with the kind of pedigrees that. I think the two big triggers, as you pointed out, one is the demerger plan, and second is debt reduction. I think what one thing which stood out is if you see the finance cost, it's almost down 10% YOY. The net debt has also come down. So I think that's something market would be looking at, more closely to make it, let's say, value closer to some of the leading names there. But anything right now with global linkages, with China involved, global factors involved, it's better to not get into it. Although metal stocks are, as I mentioned, is reasonable, especially Vedanta. But I think rather focus on the domestic plays right now, which are, let's say, FMCG, healthcare also not the generic ones, but the branded ones, rural economy facing stocks. And maybe rate sensitive. I believe, in banks, probably there is a better opportunity. Interest rate cuts will happen over the next 2-3 months. And the one big issue, which is NIM coming down, will get addressed.
Okay. That's a word coming in on some of the companies that have reported numbers. By the way, speaking of earnings misses today, there's Syrma SGS. Syrma is now down about 7%. This, of course, has been one of the darling stocks of the market, EMS play. But it seems that it's been a bit of a rough quarter on the margin front, especially for Syrma. Their gross margins have come down by 700 basis points. Even at the EBITDA level, the margin, I think, is compressed by over 200 basis points. And obviously, in a market like this, probably no room for error. Just very quickly on Syrma, Gurmeet, is this a dip that one should be buying? What's your view on the company and the stock?
Yeah, so I think you have to divide this EMS space into B2C and B2B and B2B2C. I think Sigma and Keynes probably come in the latter, and you have like the Dixon and the Ambers of the world, come in more B2C. I think if you look at the scale Dixon has built, obviously valuations are completely very very stretched at 11,000 levels. But let's say 30%, 35% of the mobiles they are making, another 30% of probably washing machines they are making. Break it product wise, and you'll see that in a lot of spaces they now have 25, 30, 35% market share. And this electronic market is huge. With the kind of geopolitical tensions we are seeing, look at textiles, for example, see the move in Gokuldas today. So I think companies which are building a lot of scale may stand to benefit as we see more disruptions in this space. So we have Dixon in B2C space and Keynes in B2B space. Sigma, if it falls a little more, maybe worth looking at, but probably want to wait out a quarter or two and see that if this is just temporary issue or there's something more structural at play.
Okay, Gurmeet spoke about textile companies, Kitex Dime Garments, Gokuldas Exports, Vardhaman Textiles. These are all stocks which are buzzing in trade, as the hope is that international buyers will now shift to India given the turmoil in Bangladesh. But it's not just textile. There are many other Indian companies with an exposure to Bangladesh. And Mangalam is now joining in to give us an overview of how the political turmoil in Bangladesh affects these Indian companies. Mangalam.
Well, let's talk about companies on the basis of stock price movement right now. And the biggest loser is Marico, understandably, because nearly 44% of its international revenue comes in from Bangladesh. Remember, this number a couple of years ago was 51%. They're looking to reduce their exposure to Bangladesh to about 40% of international business. But international alone accounts for nearly 25% of their sales, making it nearly double-digit contribution coming in from Bangladesh. Remember, up until the numbers yesterday, the stock was fairly well bid, good numbers, good commentary. So some sort of long unwinding also further pressurizing the stock, which is currently down 6%. The other one that is on our radar is also Trent. Of all the suppliers that it has, Bangladesh accounts for one of the three major countries. So you have, Hong Kong, Thailand, as well as Bangladesh. Jubilant Foodworks less perturbed by this issue, largely because 28 of Domino's stores are in Bangladesh, which roughly accounts for just about 1% of the consolidated revenues. And the street is eyeing improvement in domestic business to more than make up for any sort of loss that may come by in Bangladesh. And that's also the case for a lot of these other FMCG companies, the likes of Dabur, Imami, and others, where the Bangladesh exposure is less than 5% of sales, and in most cases about 1 to 2% of sales itself. The other company that I'm also looking at is, all these garment companies. It's exciting times where, last year we were talking about China plus one. Now, global suppliers or global buyers may go ahead and look at India as an option, which is Bangladesh plus one. And that explains why a lot of these garment makers are doing well in today's trading session. But be mindful of the fact that, we also export yarn to Bangladesh. So some of these cotton yarn exporters may get a hit, a mild hit as disruptions come about. So not every textile company benefits from this. Garment makers definitely are expected to benefit.
Okay, thank you very much for that. Gurmeet, any of these stocks you'd like to highlight?
Yeah, we've been holding Gokuldas, lucky to hold it from almost 300 levels. I think if you see the garment export number, especially the apparel export, it's 3% since 2017-18. Bangladesh is almost 12%, China is almost 1/3, upwards of 35%. And then you have Taiwan and Vietnam also, which are much, much ahead. I think you could see some disruption. It's almost been now a month with the kind of disruption which we have had. Also, Gokuldas has done some meaningful acquisitions in Middle East and Africa, which gives them an entry into EU, right? Because EU doesn't charge duty to, Middle East as well as, in certain parts of Africa. So Gokuldas is mostly US right now, which is H&M, Superdry, Puma, Old Navy, etc. There's a lot of inquiries coming from EU labels as well. Even the UK thing got a little delayed because of the diplomatic issues we had. So I think there's a huge opportunity here, and I think there's a government focus on textiles. It's a job generator. 90% of workforce is usually women, which politically also rhymes. So we are positioned there, and we are looking at few more names in this space.
Which are the other names you're looking at?
So we are looking at Vardhaman. KPR is not really garment export, but KPR is a very most integrated model. Starting from yarn to the final fabric. So textile, I think, would be a great focus area by the government in terms of additional PLI, as well as the changes happening in the global supply chain.
Okay, so that's a word on the textile makers of today. While we're discussing textile, Gurmeet, just a word about Marico. Also, I guess, got caught up in the whole Bangladesh storm, right? But otherwise, I believe the numbers are pretty okay in the quarter gone by. And how do you look at it? 6% drop right now, but we have to look at all other factors, including the nature of the market, having a bit of a defensive play in the portfolio, rural, all of that put together. What should you be doing with a stock like Marico?
Reasonable, so we don't own it, so haven't tracked it that closely. But it's news driven right now. We've seen the reaction even in textile export stocks. It's obviously news driven. Nothing is going to change overnight in supply chains, right? The way stocks have gone up 14-15%. So I think our preferred plays are Imami. Imami has shown great turnaround. Both in terms of capital allocation, rural focus, premiumization of portfolio. We like ITC, and I've been liking ITC now for a while. Unless you have this hotel demerger and then later on, their FMCG business is now 20,000 crores with operating margin in line with what Dabur has. So I think the FMCG business takes time. It should be valued at anywhere between 2 to 3 lakh crores. So there is value unlocking and there is steadiness in cash flows and there's reasonable valuation. We like Tata Consumer and we like Mrs. Bector, which is actually linked to both QSR as well as the food segment. Any correction also, Mrs. Bector obviously is quite expensive right now. Any correction in these names, we probably tend to lap up more. And in an environment like this, where this entire thing hasn't played out yet, the yen carry trade has been there for 30 years. It can't play out in one day. Literally, I know clients who actually borrowed in yen and actually repaid much lesser because the yen kept depreciating. So it just became too easy. You're borrowing 100 and you're repaying only 97, 98. I think it will take a little time to unwind this. So that's why I think the key metric to watch here is the yen movement to the dollar, at least in the short.
That's a great point, Gurmeet, and one worth taking note of. By the way, folks, just keep an eye out on the screen because the pace of the decline is suddenly accelerating again. The Nifty is looking at a 90-point drop. So, yeah, it's a pretty quick slide. Prashant?
It's led by banks once again, Surabhi. So the Bank Nifty is, it looked like it was stabilizing after breaking yesterday's low briefly, but, it's gotten right back there. So we're at 49,736 and, yesterday's low is 49,719, which is also that retracement that we were talking about. So banks really responsible in large measure for the 90-point cut, more than anything else, more than any other sector for the 90-point cut.
Even the CPSE index is under pressure. So the Nifty CPSE index is down close to about 1%. PSUs like ONGC, Coal India, BPCL in the large cap space at the day's low. That's the PSE index. So that's hurting too.
Gurmeet, I know you like Sona BLW. We've spoken about this in the past. Stocks lost about $100 from the highs, recent highs. You think becomes attractive? What's the sense? And autos, the index has lost about 8.5% in 3 days. The index itself, double of what the Nifty is lost. So I'm not sure what's going on. Are people making space for some of the newer listings?
I think it will be a bit of rotation and profit booking also. A lot of stocks like, let's say, Sandhar, Uno Minda, they almost became 2x in a matter of, few months. What has happened, Prashant, in this space also is that Sona obviously has a good EV portfolio, incremental orders coming there, both for hybrid gears and hybrid assemblies. Other spaces, what has happened is there's hardly been any capex in IC engine parts because the entire world is focused on, EV and other forms of, cleaner vehicles or new age vehicles. And look at, for example, TVS numbers today. They did 11 lakh units, of which 10 lakh is between motorcycle and scooters. iQube was about 50,000 units for the quarter, right? So even if you take industry as a whole, which is 1.2 crore, 1.3 crore units, it's less than 10%. And the bulk of the capex has happened on EV side. So what has happened is that a lot of the existing portfolios, guys who make locks, switches, people in fabrications, tooling, forgings, there's hardly been any capex. And now they are running at 80-90% capacity as auto demand comes back. So we are very constructive on, let's say, Uno, Sandhar, Sona BLW, Samvardhana, Sumi, some of the names like Lumax. I think there will be a lot of operating leverage playing out. Plus, Ukraine got disrupted because of the war. That's the second largest country on IC engine parts. So I would be very focused on auto value chain. I think there is sometimes non-glamorous sectors like textile, IC engine parts can make money for you.
Okay. All right. Gurmeet, we'll leave it there. Thank you very much for joining us. It's a pleasure as always, and thanks for being here. 23,990, so small recovery, 10, 20, 15-point recovery from the last time we looked at the Nifty, but that's about it. We take a break, we're back. We'll have Rajesh Bhatia of ITI Asset Management Company joining in on the other side. Stay tuned. Okay, welcome back. I think we're about, there's a bit of a recovery afoot. So 20 points lower now, and the Nifty is coming back sharply. I mean, actually, it's now as we speak, if we have the Nifty up, you'll see we're coming back into the green, almost there. We were down, I think, 90 points, and we're down just about 20 odd points now. So 24,035. And I think similar should be the case on the Nifty Bank, which has also come up sharply. I mean, actually, not that sharply also, but yeah. From the lows, I think we've seen about a 0.3 odd % recovery coming through. Well, let's welcome in Rajesh Bhatia, Chief Investment Officer at ITI AMC. Rajesh, good afternoon. Good to speak with you again. And Rajesh is someone who tracks macro markets also very closely. And I think his view is formed from a slightly macro-ish perspective. And then, of course, he goes down and finds sectors and what is working and what is not. So, Rajesh, what have you made of the sort of turmoil over the last 48 hours or so? And, of course, what people want to know is it now behind, or are we in a phase of slight, de-risking around the globe and here in India as well?
So, Prashant, I'd like to believe that this is a correction in India's bull market. If you look at it, just until some time ago, 15 or days or 1 month ago, US was at a new high, Japan was at a new high, crypto, gold, a lot of the asset classes were at a new high. And there has been a sudden shakeout in the narrative of all of these markets. Suddenly that risk-on trade, which had become a little more complacent, has become a bit of a risk-off trade. Not surprising then, you're seeing a lot of selling pressure. Yesterday, the FIs sold the third largest amount that they've ever sold. Clearly, there could be some kind of follow-on selling from there as well. So we are kind of witnessing that kind of a pressure. But look at how we have done. In spite of all of this global risk-off environment, what have we fallen? 4 or 5% from the top. So in spite of all of this, my sense is India is emerging as an extremely strong market. Now, how long could this last? It's anybody's guess. And there is no methodology to figuring out when does the yen carry trade kind of completely unwind. But it has happened very violently and very quickly, which means that there should be kind of some light at the end of the tunnel. But we can't figure that out. There's no methodology to kind of figuring that out. But I know, or I am quite comfortable thinking that from a India perspective, this is a correction in India's bull market.
So since we are in a correction in India's bull market, what are you doing at ITI AMC? Are you looking to up the cash levels and maybe deploy it at lower levels, or maybe tilt the portfolio, pivot it more towards defensives? How are you going to approach the next 6 months?
So, across most schemes, we don't take aggressive cash calls except hybrid schemes where we have some cash or some ammunition, so as to say, in case we wanted to up the equity, exposure. Having said that, I think we are going, and at least I as a fund manager, I'm increasingly more gravitating to one, domestic sectors. Second, I am looking at more incrementally on sectors which have greater predictability, better business models. In some sense, as I reflect on what I'm doing, I'm becoming more of an absolute return investor rather than a relative return investor in my own portfolio. So from a portfolio perspective, to answer your question, we are moving more towards the domestic sectors, avoiding global commodities, becoming a lot more conscious of exposure, export-oriented opportunities. If you look at across the region as well, what markets are correcting the sharpest? Export-oriented markets. So to that extent, I think in our portfolio, we are just carefully weighing where those exposures lie and how we should kind of maneuver them.
All right. Hi, Rajesh. Good afternoon and always good to see you. When I recall when we chatted the last time around, you said that banks is something you like. And I think you were leaning towards private sector banks, but select PSUs as well, you had mentioned, will do well. At current reckoning, how are you positioned out there? I'll tell you what, valuations of banking names are still pretty much par for the course. There's not very, very stretched on that side. The problem is the high FI holding, and if FIs are going to sell, then that could be the reason that we're seeing pressure on the banking names. So tell us your preference there and how do you see the outlook?
No, Nigel, you're absolutely right. I think the selling in the private banks, particularly rather all the banks, is more because of the FI ownership, which is one of the largest in banks there. Fundamentally speaking, look, these banks are actually underperformed quite a lot, including some of the private banks, underperformed quite a lot. I don't, in terms of valuation also, relative to the rest of the market, they make a lot more sense. Yes, to the extent you are seeing the best of NIM margins, the best of credit costs. And as interest rates decline, which is now becoming a little more of a consensus that interest rates will decline, their asset repricing could also hurt the NII growth. Although my sense is that that's already captured in a lot of analyst estimates for these private banks. So from a valuation perspective, they make a lot of sense relative to the market. They may be at a peak of their interest margin as well as credit cost. But from a growth perspective and an ROE perspective, I would say the private banks still are going to be good, consistent compounders from here on.
Okay, got that. Rajesh, you know what, stay on. We want to talk to you about real estate as well, because there's been such a hue and cry over it since the budget, right? So we wanted to get your sense, because right now, as the rule of thumb stands, I mean, all the market pundits and real estate, experts say that the rule of thumb is that your property must appreciate more than 10%. That should be the kind of, IRR if the new regime minus indexation is to be beneficial. Now, rarely do properties give a 10% kind of a flip over a short period of time. So therefore, the hue and cry about the removal of indexation. So let's just take that story forward. We, in fact, have Shireen joining in, because what we're picking up is that the finance ministry could be reviewing the new LTCG regime for real estate. Shireen, tell us, what is it that you've picked up on the matter?
The blowback and the criticism with respect to the announcements that came in for the budget was specifically focused on the removal of the indexation benefits when it comes to the long-term capital gains regime, specifically for real estate. As my colleague Timsy has also been reporting, and what we are given to understand at this point in time, the options that are being considered by the finance ministry, the one that the finance ministry seems to prefer is the grandfathering option. Whether it will be grandfathered till 2024, July 2024, or perhaps a year beyond that, is the question that remains unanswered. But what we are given to understand is that a final decision is yet to be taken. The other option, and that is what we've seen happen even as far as the tax regime is concerned. The old tax regime continues to coexist with the new tax regime, given the option to consumers, to taxpayers, to switch depending on what they feel they most prefer. So will that be the preferred route that the government decides to take forward? We don't know yet. But again, a decision has not been taken. But these are the two options on the table that are being reviewed at this point in time. Now, remember, again, to take our viewers back to the conversations that we've been having, including with the finance minister and the finance secretary. When I put this question to the finance minister a few days ago, asking if the government was considering a review or any kind of amendments, the finance minister had said that she would speak only in Parliament, because the finance bill is now the property of Parliament. And when I'd asked the finance secretary had said that in his view, in his personal view, there was no need for a review, but he did make it clear that it was eventually going to be a political decision. So remember, the finance minister is expected to reply to the finance bill in Parliament. It was expected today. We are given to understand that's now likely tomorrow. But these are the options at this point in time. If any relief is provided, it's likely to be restricted to the real estate sector for the purposes of providing some relief that taxpayers felt was necessary on account of the indexation benefits being done away with. A final decision, though, is awaited.
All right, Shireen, thank you very much for that. Rajesh, there you go. The issue is still a very hot one. But taxation aside, I mean, how do you look at things in the real estate space? From the equity standpoint, stocks did really well. What have you made of all the noise around removal of indexation, and what's your view on the sector?
Well, from a stock market perspective, I think a lot of real estate companies have done extremely well over the last couple of years. Their pre-sales numbers have tripled. That just kind of gives you the sense of demand visibility that they have. When we speak to a lot of real estate companies, they tell us inventories are dropping. Prices are actually moving up. And their confidence in build-up of new development has gone up tremendously. So all of that augurs very well. And real estate typically is a very long cycle play. So we have begun this cycle probably 2 or 3 years ago, and probably there's greater visibility that demand is sticky and that it'll last another 3 or 4 or 5 odd years. So one way to play the real estate is through these companies. And of course, it's getting more concentrated with the organized sector. But the other way is, of course, to kind of go into affordable housing companies or, wires and cable companies, etc., which are also an equally good way to participate in the real estate cycle, which has been extremely strong as far as India is concerned.
Okay, all right, Rajesh, we'll leave it there. Thank you very much for joining us. It's a pleasure having you here on CNBC-TV18 and a good chat as always. 60 points down again. So, I mean, the market did not really go all the way back into the green and we are still there a little lower on the Nifty. About 0.6% cut on the Nifty Bank, but trading as we have been dangerously close at below, but around yesterday's lows. And then important retracement support as well. We take a break. We're back. Nimesh gets us what's happening in dealing rooms on D Street Chatter. And of course, we'll get you some trading ideas as well. Stay tuned.
Welcome back. Well, the markets continue to remain under pressure. Today is actually a disappointing trading session because we started off well in the green and we couldn't even hold in the green for the time being. We're deeply in the red, particularly at the Nifty Bank. But Nimesh is with us. Nimesh, what's the sense you're getting today? I mean, yesterday was a weak trading session and building down on yesterday's losses, we're down another 80, 90 points.
Well, down largely because of selling pressure.
Yeah.
We saw a large sell figure yesterday and that trend of FI selling continues in today's market as well. That's the overall sense. I guess that's the reason why we have given up most of the early morning gains, and even the global markets look a bit wobbly, right? It's not like everything is clear now, and you're back to the positive thing. So I guess the time being we'll have to consolidate in these levels is the overall feedback. And as I said, there is selling pressure from larger FIs. Look at the Bank Nifty; it's down almost 900 points from the day's high, and that's again backed by FIs selling. across private banks as well as PSU banks, there is selling pressure from larger FIs, including the domestic mutual funds as well. In fact, there is a chatter as well that maybe some domestic mutual funds has started seeing some bit of redemption pressures as well. So I guess that's going to be the key, right? The domestic money is what was helping the markets to hold on, and if that gives up, you might see correction in the broader market stocks. Also, the selling pressure. I was just looking at the list of stocks where there is selling pressure. Most of the names where there is selling pressure is all the stocks are above the 2 plus average mean. So all the expensive stocks is where there is selling pressure from the larger FIs. So it looks like there is a valuation call as well as far as India is concerned. So that's something to track going forward. Both the FI money has been a seller, but if the domestic money is slightly on the sidelines and they don't invest, I guess we'll see a bit of correction in the expensive stocks. That's the sense from the flow perspective. I guess real estate is a sector to watch because of the anticipation of some relief in the finance bill. If that has to come, you might see some further reaction. But broadly, it's selling pressure, and largely banks and the expensive names is where the FIs and DIs seems to be selling.
Well, Nimesh, the bulls will be hoping for a time-wise correction. They wouldn't mind it now because it appears that price-wise correction is suddenly taking over. So let's see how that goes. But individual stocks, what are you picking up?
Well, a lot of stocks which are buzzing in trade despite big selling pressure. So the first name is NTPC. Well, the stock is under pressure because of the overall markets. But for the last couple of days, there is very strong delivery-based buying happening. I understand a leading long-only fund is an active buyer in NTPC at this level. So that's the first name. The second name is BEL. Under pressure today, largely on the back of the big BOFA downgrade, where they have downgraded all the industrial names. But also there is selling pressure from larger FIs as well as some domestic mutual funds as well. So I guess that's the reason why BEL is under pressure today. The third stock is GMR Airports. We've seen a bit of a pullback in that stock from the yesterday's low, but there is small delivery-based buying as well from larger FIs in GMR Airports. And the last is Protein E-Govern. I've been covering for the last few days now. Again, the stock is under pressure today on the back of soft Q1. But from a flow perspective, I guess one of the leading NBFC, which is owning close to 3%, that's completely cleaned out now. So their selling is largely over. And some HNS have bought as well in the last many days. So bit of under pressure today on back of earnings. But again, there is flows from larger HNS. They're looking to buy at lower levels.
Yeah, that's right. And a couple of these stocks, strong hands coming in there, but delivery is something that the street ultimately will go according to. But Nimesh, just one more stock I wanted to ask you about. Patanjali, we saw a large trade in the last few minutes. Any clue about that?
Nearly 24 lakh shares is what I checked. There was a large block of 24 lakh shares. Looks like some HN investors were sellers in today's block and a single buyer, likely a US-based fund, was a buyer in today's block. So I'm not sure whether it's more than 5%, 0.5%, so disclosures will come or not. But in case the disclosures come, it would be interesting to watch as to which US-based fund has bought in today's block deal.
All right. All right, Nimesh. Thank you very much for that. So that's all the buzz from dealing rooms today. Let's go back to Mitesh and take final stock of the market and any trades that one can look at. So the good news is that this decline, it's been arrested. It's not become a free fall, but it's still about an 80-point drop on the Nifty. Mitesh, final trades?
So we have a STBT on M&M that's closing below yesterday's close, so slightly negative, and the setup is also turning negative. So M&M is something which I would recommend selling with a stop or taking a STBT position with a stop at 2648 for targets of 2605. And Britannia would be a reverse BTSC kind of a trade. Keep a stop at 5835 and 5900 plus would be the target area.
Okay. Got that. Mitesh, thank you very much for that. Let's also get you some previews, right? Because we'll essentially have numbers coming through from Lupin, which is later today. Ekta is here with what to expect from Lupin's first quarter. Strong numbers are expected, by the way. Ekta, over to you.
Well, for Lupin this quarter, the street is anticipating a revenue growth of around 7 to 8 odd percent, margins of around 19 to 20 odd percent, and profit of around 560 odd crores. Now, the expectation is that the company is expected to report a single-digit revenue growth this time round. The sales are likely to be capped because of a high base in the same time last year. However, the street is expecting a pickup in terms of sales in the US on a sequential basis. So last quarter, they did around $209 million. So this quarter, the street is anticipating maybe a pickup to around $220 million. Spiriva generic, which is that inhaler that they launched, sales are estimated to be around $35 million. To watch out for the contribution of this drug, which is used for an overactive bladder. Mybetriq generic, which is expected to contribute this quarter for Lupin sales. Now, for the domestic market, expect growth to be around 10 odd percent. India was up around 8.3% in the previous quarter. Margins should remain around 19 to 20 odd percent. So the margins have in fact been tracking 20% for the past 2 quarters. Commentary with regards to US sales margin outlook would be key for Lupin this time.
All right, Ekta, thank you very much for that. With that, we take another quick break, come back with the markets on the other side.
Welcome back. The Nifty is currently below 24,000 by a smidge, down 60 odd points, while Asia closed up with strength. Europe right now is in the red. The French index CAC is down 0.6%. The DAX is a cut of about 1/3 of a percentage point, and the FTSE too is down nearly about 0.5%. So the problem is global. And earlier today, in fact, through the day, we've been chatting with global experts on the state of the global markets, where we are headed, on the U.S. Economy, and whether the U.S. economy is on the brink of a recession. Listen in to the experts as they weigh in.
For the first time, we saw that wage growth was much slower than the past, and more importantly, that the layoffs were turning to happen.
Yes.
And so it's a combination of the details, not so much as the gapping down, but the details that brought about the change that now we have downside risk on inflation. Remember, wage growth is much slower, and we have downside risk on labor markets. Now we have 50 in September, 50 in November, and then every meeting, not every quarter, every meeting we have 25, so that by the end of July of 2025, we reach a terminal rate of 3% instead of 10.26.
We don't think the Fed will need to cut as aggressively. And I think that's been a factor. We talk about the yen carry trade, and look, the Bank of Japan hiked rates. We had expected that, but it happened at a time when we had a confluence of factors affecting markets. And clearly the carry trade unwinding, which has been very, very severe indeed. And we know that Japanese investors had a huge amount of outflows into emerging market carry and higher carry trades globally. But I do think we've seen probably the brunt of this move in terms of carry trade unwinding. We've already seen a lot of position shifting, and I think positions are moving closer to neutral.
The market is beginning to recognize recession. We saw the yield curve uninvert it was just a hot minute today, but boy, that really got the market's attention. The fact that the 10-year yield was finally where it should be on the yield curve, if you will, the yield curve steepening. So I think we're getting enough signposts to suggest that if the U.S. is going into recession, that we've seen the best we're going to see out of stocks.
The Midcap Index is now down 0.7%, and from the day's high, it's a fall of 1,500 points in the Midcap Index. Pull that up, the Midcap Index, and lots of individual names are hurting. You've got PFC, which is now reacting to weak numbers. Siddharth Khemka from Motilal Oswal Financial Services is now joining in. Siddharth, Nimesh was just telling us about Protean eGov. This is a stock which has been a big outperformer. Influential market men have been buying Protean eGov because it's a play on India's digital stack, the digital infrastructure stack. But this quarter's numbers have been disappointing. Revenues are down 11.5% quarter on quarter, year on year also down 11%. Profits are down 34% year on year. So numbers have not matched up, and considering how much Protean eGov stock has rallied, you are seeing a correction. Have you studied Protean, and is this correction a buying opportunity?
So, Rima, we have not looked at Protean. We don't cover the stock. But if you look at some of these digital plays, the likes of CAM, CDSL, and some of the other companies, I think they would definitely have some bulkiness in terms of lumpiness, in terms of the nature of the revenue recognition. And that is what is hitting them. If we, from our coverage universe to play the digital space, we definitely like some of the capital market themes, for example, CDSL and CAMs, which are on play on the direct equity as well as through the mutual fund route. Numbers we are there for all of us to see the sharp rise in the demat account openings, the sharp rise in the SIP books. So both of these, I would say that figure out among our digital plays to play the financialization of the scenes.
Okay, hi sir, good afternoon, good to see you again. Well,
Okay, so that Bharti Airtel is on the back foot post their Q1 numbers. The stock is down close to about 1.5%. Nothing in the conference call has also gotten the stock higher. Where do you stand on Bharti Airtel?
Yeah, Rima. So I think overall, if you look at Bharti Airtel, yes, we believe that more or less the numbers are pretty good and in line. There is some concerns with regards to ARPU being lower than expectation, which is impacting margins. But we believe that the core growth in India is pretty strong. Plus, the Africa business growth is definitely picking up. And the home business, that is where we see a silver lining of 5% Q-on-Q EBITDA growth, led by 5% subscriber addition. That is a new growth driver. Capex is moderating and deleveraging continues. So overall, we are in a positive view continues on Bharti Airtel. We have a buy rating. So our target price was 1650, which will get revised after the today's con call.
Okay, all right. What about insurance companies, Sid? What's the view out there? The stocks had a big run. Nothing negative came out of the budget. There were fears, other fears as well that were surrounding these companies. They rallied a goodish bit, but today they're some of the biggest losers. Preference are there, and would you look to buy insurance?
Hi, Nigel. So good to see you. So if you look at insurance, I think definitely the numbers are improving, and the consistent growth in the quarter has been good. And some of these, so recently post numbers, we have also upgraded HDFC Life Insurance, which was a neutral for us to a buy. A lot of these stocks have run up in the recent last few months, and I think definitely closer to our target price. Our preference is SBI Life, which has been the most efficient player. We see a strong growth both in the annual premium as well as in the VNB margins. Continues to remain the most efficient with the ROEs in excess of 20%. And a strong growth of about 18 to 20%. So that remains our preferred pick. Target price is 1900. HDFC Life has seen improvement in its numbers because of the change in mix that is helping improve margins. Valuations were expensive, which came down, and now we have a target price of 750 on HDFC Life.
Okay, all right. So that we're getting close to the close of what's been a slightly volatile day once again. So if we see the screen right now, the Nifty again has managed to pull back from the lowest point of the session. So what was looking like an almost 100-point cut about 10 minutes, 15 minutes ago is looking slightly better because we're trying to inch back towards the flat line. Still about 20 to 25 points gone from the Nifty. If we talk about the weak areas today, then it has to be financials. HDFC Life, the stock that we were just discussing, is ending with cuts of about 4.5%. SBI Life is the second weakest stock on the Nifty with about a 3% drop. State Bank of India, HDFC Bank, Axis Bank. So it's all these financials, Bajaj Finance, all of these stocks on the weaker side. Then some profit taking continuing on a Mahindra and Mahindra. There's been weakness on some PSU names like BPCL and ONGC as well as Coal India. On the upside, it's a move to safety. So Britannia, HUL, Cipla, a lot of these pharma and FMCG names, they stand out, as does IT, by the way. A lot of IT names are up about 1 to 2%. LTI Mindtree, Wipro, TCS, Tech Mahindra. This is where the investors were pretty much gravitating.
Okay, let's get through the mid-cap action then. On the way up, Indraprastha Medical, not a stock we often talk about, but 20% upper circuit in a weak market on the back of strong Q1 numbers. Symphony, good Q1. It's also a seasonally strong quarter for them, for their water cooling business. So Symphony, 70% jump in their revenues year on year, 50% quarter on quarter, stock up 19%. And then you've got the textile makers. So Gokuldas Exports, Kitex Garments, KPR Mills, Arvind, across the board, big gains. BLS International, where the company's margins expanded by 600 basis points on a year-on-year basis, also ends up with a gain of about 10%. First Source PCBL, that's Philips Carbon Black, from the Sanjeev Goenka Group, continue to come in